If you own or run a limited company in the UK, your tax return may have just got a bit more complicated, and HMRC might even fine you even if you've paid the right amount of tax. Hi everyone, today I'm very pleased to be joined by Gravitate director and co-owner Jonathan Carr. Jonathan is a chartered accountant who specialises in helping businesses in both an advisory and a compliance perspective. In this video, we're going to be talking about some new reporting rules that are coming in for company directors that you may not have heard of yet, but it's really important that you know about it. So Jonathan's going to be breaking down what's changed, who it affects, and basically what you need to do about it. So yeah, in a nutshell, what's happening to reporting for directors?
Yeah, so from the 25-26 self-assessment tax returns, there's going to be more emphasis on directorships and closed company rules. And closed companies have been around a very long time, but the new reporting structure HMRC has brought out has meant that you need to link more data together between what directorships you have, what shareholdings that's linked to, and then how the income from those, be it pay as you earn, dividend, however that income is then linked and reported on that to ensure that basically HMRC can see the full picture, and then there's fines if that's not done correctly.
I see. And just for anyone who's not aware, what actually is a closed company?
Yeah, so a closed company is a really weird name for something, but it's any company that is controlled by its directors, i.e. the directors are also the shareholders, or it has less than 5 directors.
So realistically, that's going to cover most owner-managed businesses?
Yeah, most owner-managed businesses of most sizes is going to be captured by this, and should have always been ticking this box on the returns, but it's not been a necessary requirement. It's been, it's best practice to do this, but now there's actually levies and fines being built into not doing it. So it's now become that actually a very important part of the self-assessment process.
Okay, so going back to before this then, so what did directors previously have to report on, and why was that apparently not enough?
Yeah, so directors, you always had to, if you went through payroll, you should always tick if you were a director, if you weren't one, because your employer's NI is calculated slightly differently for directors compared to a normal employee. But the other side of it, just to let them know that business or that income was from a closed company, that was it. And it was mainly around your pay as you earn income, whereas dividends you just put in saying I received a dividend from a business of X amount, you put it on your return, you paid your dividend tax. But now they're wanting to link a closed company dividend to that closed company, and then almost have closed the loop with other things that have come in recently. And then you declare dividends from other sources without having to put that extra bit in. But they're now just making sure that they understand where your dividend income's coming from, not just the pay-as-you-earn income, which is already linked by pay-as-you-earn references.
Okay. So, and Jonathan wrote a very helpful blog on our website, which you can find in the description below. But in that blog, you mentioned reporting on your highest shareholding during the year, not what you hold at the end.
Yeah.
What does that mean exactly, and why is that important?
So obviously, with owner-managed businesses, you do have situations where you sell shares, or you might gift shares to employees, or EOTs and the likes. Obviously, lots of different transactions happen. But HMRC, all they care about in that year is what was their highest percentage. And that, again, is to understand the control aspects of businesses, obviously, because certain shareholding percentages means you have a controlling voting share or a minority share. But also, there's a tracking bit in here of you have, say, 100% of these shares in one year, and then that goes down to 20 the next. There is some sort of transaction that's happened there. And by that being flagged on the returns, there's probably going to be future systems within HMRC that goes, well, that person went from 100% shareholding to 20, where's the capital gains? If there's no capital gains, what other systems are being used, like EOTs? But that, obviously, that capital disposal should have been logged somewhere, even if there was no tax to be paid. So again, it's now building in that process of they're wanting to see how it processes through from ownership and then how the dividends are linked. Obviously, if there's multiple shareholders, they're also going to be linking, well, they've got 20% of the shares, but they've got 100% of the dividends. Is that correct? Is there any tax avoidance going off? So it's just they're creating a wider net to start capturing as much data as possible.
Okay. And what about directors who take, say, no salary and no dividends? Do they still need to report even if they're effectively reporting a zero?
Yeah, and that's where the admin burden has actually really stepped up again with this extra reporting needs. because you've got the situation now where there's actually a section on your self-assessment where you tick that says unpaid directorships, where you have to put in then every directorship that you are linked to, even if you're not a shareholder. So there's a box to tick to say you're a director of X business, what's the company number, and then there's a box to say are you a shareholder, and then there's a box to put your percentage in. Obviously, there's no dividends to declare it, there'll be no tax on that, but they still want to know that, what are your directorships. And again, it's feeding that data back to what obviously the changes to Companies House. So again, closing the loop.
Right. And then in theory then, as this is a reporting standards thing rather than a tax collection one. Yep. So you could pay the perfectly correct amount of tax but still get fined if you get this wrong.
Yeah,
right?
That's the case, yeah. And the HMRC have released that each individual error in this area will be a £60 fine. So each directorship missed, each close company unticked. Obviously, they're very vague about each instant, but they're saying a £60 fine. So say you have 5 directorships with no income on them, so no tax implications, but you don't put them on your return, you could be looking at a £300 fine, just purely because you've not reported correctly, not necessarily that you've not paid the right tax.
Yeah, and they can really stack up if you've got a particularly complex business.
Yeah.
So given the first affected return isn't due until January 27th?
That's correct, right? The end of January.
When should directors really be starting to prepare? Is it right now?
Yeah, right now. Like currently with our clients, we get ensuring that obviously when you look after a client, we've got all the directorships, we're looking after multiple companies, but there are obviously unpaid directorships, which is definitely going to be the one that catches most people out. That are, because there's no services and no need to do anything with it, they're the ones that might go unnoticed. So we're working on stuff about going through and just being like, every directorship, regardless of the size, let us know, regardless of shareholding as well, directorship and shareholding. We need to know like ones, even if you don't have it. And then we're just making sure that is on the data. And then the key thing after you've done this like data gathering is ensuring that we keep it up to date. Because every year you're going to have to declare on it. And again, I'm guessing we'll get to a point where if a directorship ends and you don't take it off your return, that is also an incorrect submission and probably finable at that point. So it is definitely going to be much more of ensuring that you've got the right software, the right processes to ensure that we're gathering this data.
So you mentioned using the right software and gathering data. These sound like admin at the start, but they're actually quite beneficial to get this stuff right, isn't it? So is there actually any good news for directors that come out of these additional requirements in terms of establishing those good data habits and things like that?
Yeah, 100%. Yeah, I think sharing data with your accountants and passing data on and also ensuring that when things change, you're speaking to your accountant. Obviously, we have a very good relationship with our clients and we see each other often, but it's just prompting those conversations now of, well, this has changed and this has changed. Because all these are just minor directorships, but they can have knock-on implications. Or you might be like, well, I forgot I had this directorship, and it could be useful to like link it into the existing companies and stuff like that. So it's just encouraging the right behaviour. And obviously with the world, the way it's going and automation, there is ways to make this easier. And once you've done the initial hard work, it's much easier to maintain than it is to start from scratch.
And would you say these new reporting requirements, so they're all part of HMRC's broader mission to basically digitise the whole taxation system?
Yeah, 100%. I've mentioned it a few times, but to me, it's closing the loop. We've got the ID checks on Companies House now, so we're removing loads of fake directorships, and we're also linking, like, there were situations with Companies House where you could go on as John Smith and then also go on as John Michael Smith. But Companies House didn't understand they were the same person. They thought two separate people. So the ID checks have really, shrunk that down. But obviously that's now data that's in there linked to year ends, and now they're going to capture it on the self-assessments are according to Companies House, you're a director here, here, and here, and according to your self-assessment, it's here, here, and here. And obviously they're not giving you that data to help you out. They're almost using you as a check of, we already have this from the ID check. We're now getting this from the self-assessment data. And then we're looping it together. Your account show a dividend of 50k. You've only put 30k on your return. So they're just using it now to have that wider digitization. But also, like I said, they're now going to obviously close the net. So people that are under declaring dividends or not declaring income, it's now going to get much harder for those to go unnoticed. Even with the HMRC system as it is, they're kind of, let's say, closing that loop. And obviously, where you are declaring things correctly and you are paying the taxes you should, there is no issue. It's purely actually just linking things together, and actually should make life a bit easier because there's no longer going to be the ambiguity on it all. But it is definitely going to make things much more interesting in the future for how they track the data through.
So all in all, it's a case of be aware that don't panic.
Yeah, 100%. Yeah, like obviously I know
Speak to
that.
your accountant.
Yeah, speak to your accountant. The £60 fines per error. Obviously, that's quite hefty if you miss a note and if you have rather complex structures. But speak to your accountant. There's plenty of time to get things submitted before that January deadline. But the returns are going to take longer than usual because there's more data required at this point. So if you do leave your return to the last minute, you run the risk of things being rushed and also not having time to get it submitted in time. So it is a real push to ensure you're doing the self-assessment this side of Christmas to make sure that you get ahead of it.
Reason number 100 to
Yes.
pay your tax
Yeah, just another reason to get your tax return done early. Yeah.
Okay, brilliant. Well, was there anything else that you think probably wants to be mentioned on this? Or
no, I think obviously, there's a lot of jargon like closed company, which people haven't heard before, but it is crucial kind of just to understand that it's most owner-managed businesses, and if you're unsure if you're in a closed company or not, speak to your accountant because they'll know.
Okay, brilliant.
Yeah.
Well, I hope that's been useful. If you want to see more videos like this, you can subscribe to our YouTube channel right here, which has got all sorts of stuff like this on it, which we enjoy making and hope you enjoy watching. If you've got a question about anything related to this video, you can email us at hello@gravitate.digital, or you can visit our website at gravitate.digital. Otherwise, thank you for watching.